Hey everyone, in this video we're going to be looking ahead to which companies are reporting in the stock market next week. We're going to go day by day. I'm just going to highlight what companies I'm most interested in hearing from, and then we're going to jump into some of their stock charts, what needs to be true for their stocks to go up, what's some upside, some downside, how are they valued today. So if you like this type of content, please subscribe to the channel. It would be awesome if you give a thumbs up to the video. That really helps small channels like this one a lot. And if you own any of these stocks or have any opinions of these stocks, please let me know in the comments as well. Okay, so this week is a bit less hectic as some of the past weeks that we've done. Not as many big names reporting earnings. But with that being said, we still have some interesting stuff going on. We're just going to brief through the first half of the week because lots of the actions in the back half. But some of the companies on Monday that are reporting that you may be aware of, BuzzFeed, small social media company, could be interesting to get a little bit of a soundbite, anecdotal feedback on how the ads market is doing, especially after some of the rhetoric we heard from other digital media companies. Getty Images, I didn't even know this company was public. I'm not even sure what their business model is, but that's a name that I've heard of. And then lots of these other companies, I've heard of GitLab, but lots of these companies I'm not too interested in, don't even know exactly what they're doing as a business. Going on to Tuesday, a lot of the same story. Nothing here I'm overly interested in. And then on Wednesday is really where the action picks up. You have a handful of companies that I'll be interested in their report. The first one is Arcos Dorados, which is, I believe, the largest franchisee of McDonald's in South America. So they own tons of McDonald's in Brazil and across other countries down in South America. We can talk about that stock a little bit. Um, Adobe is a big one, a really big one. Lots of stuff going on with that company. They've kind of gotten tied into lots of the AI swirl that's going around with ChatGPT, and if they're well positioned for the future. Their stocks trading cheaper than it has been historically. They have a couple big acquisitions that are getting challenged, so we'll talk about that one as well. And then Five Below is another one in terms of a retail space that's really hot right now, despite everything going on with the consumer. So we'll talk about that one. Let's start with Arcos Dorados. So this is a interesting company, just because we're used to McDonald's trading at, a $260 billion market cap, or whatever it may be, 200 and change, and being a very expensive company, um, trading 26, 27, 28 times earnings. Here's a company that has 100% exposure to South America, essentially, but they trade at a much cheaper valuation. They also have a lot more operating risk, and that's probably one of the reasons why they trade at this valuation. Where with employee costs going up, turnover, other expenses on the P&L, that McDonald's, since they're more of a franchise model and they charge rent and royalties and license fees, they have a much cleaner revenue and profit stream. So if you're looking for a better PE on some McDonald's exposure and you're not scared of South America as a market and maybe some currency fluctuations, this could be an interesting stock. I own McDonald's, so I always take a peek at how, they're one of their largest franchisees is doing, just maybe as a precursor for the broader company and for future earnings reports. But this is one that's really traded sideways over the last number of years. So it'll be interesting to see, given everything going on in their market and inflation and stuff like that, what happens with their earnings. You can kind of just look here in terms of their company. So most of their business in an individual country is Brazil. It's the main pillar of their business. And it's interesting here. You can see they're doing comps up benchmarked versus inflation. So that, I think that even just goes to show how big of a deal inflation is in certain areas of the world. But then they're also, I believe, is probably North Latin America district. I'm not sure, and South. Actually, that doesn't make sense because Venezuela's there. But nonetheless, this is just different countries around South America. I think like Chile, Argentina, etc. they own a lot of franchises in. So interesting business, a lot more capital intensive because you're actually owning the business. But with that being said, still exposure to McDonald's and part of the world at a more reasonable PE. Going into Adobe, so you can kind of look Adobe stock this year is trading flat essentially, down 2%. And then over the last 1 year, down 20%. A lot's going on with this company. So it'll be really interesting to hear from them on earnings. I think they had very strong outlook for 2023. So starting to get a more clear picture of if they think that'll come to life, if they'll come in short. I think that poses some potential risk if they lower the outlook, obviously, for the remainder of the year. But I think more fundamental questions on the business is around ChatGPT. There's been lots of noise about ChatGPT 4 coming out and it involving the creation of pictures via text. You just put in what you want to be created and it'll make an image for you. And then also doing the same thing, just inputting what you want being created, and it makes a video for you. So as you look at the market that Adobe serves, this potentially infringes kind of on their territory and maybe their pricing power a bit. If this is an alternative that is out there, I think that has some investors a bit worried, just to keep an eye on what's going on there. And how much is Adobe going to be talking buzzwords and AI during their call this week? I think it'll be interesting to see. The second thing on Adobe is their acquisition. So they announced a huge $20 billion acquisition of Figma, which is a disruptive player in their space. But I believe trading at like 20 times earnings, or sorry, 20 times revenue. So very dilutive from a profit standpoint. The stock went down huge when it was first announced, but now it seems like it's getting tied up. You can kind of see regulators across the board are looking to oppose the Figma acquisition, EU antitrust probes, it goes on and on. So it'll be really interesting to see how that pans out. Regardless if it closes or not, I think it's very tough from a priority standpoint to have an acquisition that is over 10% of your market cap in the midst with all this other stuff going on, and then when it's dragging 1 year, 2 year, 2.5 year, you really have to pull a lot of resources, a lot of focus away from your core business to get it done. Not to mention, if it doesn't get done, the break fees and stuff like that, that's destructive to shareholder value as well. So it'll be interesting to hear what they say on Figma, if they think they have a quick path forward. If not, I think that's probably a con for the stock, because it's going to continue to drag, continue to pull money as they try to close it, as well as priorities, resources, and attention away from other big things that they're working on. And then going into Five Below, I'm really interested on what this company reports. This is a company that, as consumers get more impacted by macroeconomic variables, they tend to trade down in where they shop, where they buy stuff. And Five Below's really benefited from that, as people go there for more things on their shopping list to save money. But you can just see how much this stock's rallied. The market's down 10 to 20% in the last year, and Five Below's up 32%. So 50% outperformance, even this year, as inflation's kind of continued higher than some have expected, up 15%. Longer term, up 200%. $11 billion value, and they're pulling in almost no income. But let's look at the revenue at least. If I look, they're doing about 1.4, 2 billion, like $3 billion. So they're trading at almost 4 times revenue. Lots of retailers like Walmart and stuff trade under 1 times revenue. So I think this stock is extremely expensive. I get the story. I understand why investors are flocking to it as like a more recession-proof operation. But my gosh, do I think there is risk in the valuation of the company at like a 4 to 5 times revenue multiple for a discount retailer. I think if they don't post good numbers or don't have a rock star outlook, they're at pretty big risk here of a stock drop. Okay, Moving on to Thursday, a lot of names on Thursday as well. We have Dollar General that I'm interested in. Fedex is another one I'll keep an eye on, and then Meta is a stock that I own. So really interested in what they announce. Lastly, we have Sonoma rather, which I did some quick research on. Was really interested in their valuation. I know they play in an interesting space or maybe an at-risk space, but their value seems to be pretty low. So that's one I wanted to touch on as well. So we'll start at Meta. So Meta, we don't have to get into it because it can be its own video, but has had a roller coaster. I think what first and foremost, what I'm looking for on the call is strengthen their core business. So obviously Instagram, Facebook, how's their path to monetization on both Reels and WhatsApp going? I think that'll be really core to make sure the core business is healthy, and the business that everyone actually wants to invest in is healthy and doing well. And then second to that, very close second, is sentiment around Reality Labs. How much money did we burn this quarter on it? How much money are we planning to burn on the year? Um, Mark Zuckerberg called it the year of efficiencies for the company. Is that actually true? Or is his pet project still taking over the entire company's balance sheet and financial outlook in terms of EPS and capital allocation? So those are really the only two things I'm looking for on the company. It'll be interesting to see how much shares they bought back before the company went up 100% um, over the last couple months. So this is one that I'm personally very interested in. We'll definitely listen to the call. We'll look at the report, and hopefully, fingers crossed, he says the right things, does the right things. I think this stock can jump 10-15% easily if they kind of reel back Reality Labs in terms of sentiment and how much of a priority it is on the call, and report strong core performance for their Facebook and Instagram apps. Moving over to Fedex. So FedEx's stock trading about 15 times, down a bit over the past 1 year. It's really run this quarter, so that's actually interesting. I'm not exactly sure what happened here in January. Seems like that's worth learning more about before coming up with some thoughts on the company. But overall, I think around a 15x on FedEx is reasonable, fair, not a bad point to get in, but also not a screaming buy. And yeah, I just think FedEx is a good proxy for what's happening in e-commerce, broader economy. So I like taking a peek at their earnings. Not a stock that I've ever bought or that I'm overly interested in buying, but I do think it's a company that does have, some provide input to a macro lens of the economy. So we'll be keeping an eye on that one. Next is Dollar General. So I consider Dollar General to be similar to Five Below in terms of the sentiment of consumers trading down and where they're buying, so on and so forth. And they're growing. They're opening a lot of stores in the markets that they play in, more suburban areas, I believe. Much bigger company, almost a $50 billion company here. I didn't know this company was that large. If I look at their earnings, they're making about 2 to 2.5 billion. So the company's trading at 20 to 25 times earnings. I prefer that than to Five Belows at bird's eye view. So this is a company that still probably a bit pricey for me, but I do see how it could be a defensive play, and maybe a stock that some people are interested in for the long term, but you're not getting a steal on it today. I think if you go longer term on this stock, it's performed super well. So from 2016 up 160%, pretty darn good, 20-25% compounder per year on average. Anyone would take that. So companies perform well. That's probably priced in terms of how well they've executed. So not a stock I'm interested in at these valuations, but I am interested to see if they are benefiting from consumer trade down, if that provides some macro perspective as well. and I do like that they're at least trading at a more favorable PE and price to sales than Five Below. And then wrapping up on Williams Sonoma. So Williams Sonoma is a company that I knew the space they played in, but I didn't know too much about the brands and stuff that they own. It was really just when I was looking at their earnings for this week and their them on the schedule that I looked a bit more into the company. Looked like they're trading at under 8 times earnings. So I said, okay, this is a bit interesting to learn a bit more about. So I went into their investor relations, looked at some stuff. This is just a quick summary. They do about $8 billion in revenue. So even in last year, they did more revenue than their market cap, I believe, because their market cap is 8 billion and they did 8.2. So for a retail company, this is closer to what I like to see versus Five Below at 5 times revenue or whatever it was. And it looks like they've been growing. They've been outpacing their categories, 22% growth in the last number of years versus 7%. So they're gaining market share. It's a fragmented market. With that being said, I can see this space getting absolutely clobbered in a bad economic environment. So this is one that if someone was, or if I was to start a position, it would be very small in nature. Maybe dollar cost average through bad times, but would never be a large position for me. And just one that would be strictly a valuation play of trading 7-8 times earnings, which returns 13 to 14% to or 14 to 15% to shareholders through dividends, buybacks, reinvestments in the business for growth. Some of the brands they own: Pottery Barn, West Elm, Williams Sonoma, obviously, and then some of their spin-off brands like Pottery Barn's Kids. They seem to also have a really strong e-commerce presence, which I like to see as well. So this is one I might do some more research into just as a valuation play. So we'll look at them a bit more before their earnings, but overall, don't own. But this is one just based off valuation. I may not be able to help myself, but to test it out a bit or do a bit more research. So that's the summary for this week's earnings. Let me know if there's any of these stocks that you're also looking at, any ones that I did mention that you have broader perspective or opinions on, or any company that I didn't mention, whether it's on this screen or not. If you like this type of content, please subscribe to the channel. We're still a pretty small channel, so it'd be great to get more eyeballs, and hitting the like button and subscribing to the channel really does a lot. Would love to hear from you guys in the comments, and I'll see you guys in the next one.